Good morning, everyone, and a very warm welcome on this rainy morning. Today we have with us Mr. Satish Charipalli. He will be guiding us on the regulator's perspective on the FEMA transactions of, say, cross-border transactions. He will be covering ODI and FDI regulations as well. Before we start the session, I would request you all to please stand up for the Institute motto, sir. Request you all to please keep standing for the national anthem. Request you all to please keep your phones on silent mode during the meeting. To introduce our today's speaker, I would like to invite CA NM Jain sir, who's also our past convener and coordinator for today.
Good morning, friends. On this very good morning. First of all, I thank our convener, Mrs. Purvi Bagheria, to give me this opportunity. Today, the session is subject of the session is capital market transaction. And on this subject, today we have with us Mr. Satish Charipalli, is head of product for capital transaction at IDFC Bank. In his role, he works closely with various stakeholders within the bank towards resolution and execution of various capital account transactions and also conduct knowledge session for channel partners. As a chartered accountant by qualification, he has been in banking industry for last 15 years. In his previous stint with a private sector bank for 11 years, he was responsible for transaction banking and product sales for capital account Pan India. He will share with us practical use cases and valuable insight on RBI expectations. Before he start his lecture, I request Mr. Sambhunath Katarva to present a memento as a love token. Sambhunath Katarva. Sorry, Kailash Katarva. Sorry, Kailash Katarva. Now I present before you Mr. Satish Charipalli. Please welcome it with big round of applause.
नहीं I think this is enough. So good morning all. We deal with actually our team is called Structured Solutions in IDFC First Bank. Other banks may call it capital account team or something like that. So essentially, we deal with all cross-border transactions which are governed by FEMA. So it will cover your foreign direct investments into India. It will cover your overseas investments outside India. It will cover your external commercial borrowings, long-term debt. And of course, there are other matters relating to that, like escrow accounts, RERA accounts, import-export. There is a different team altogether which handles trade transactions. License branch project office, special accounts for non-residents, special non-resident rupee accounts for non-residents, for tax refund purposes. So all these areas actually come under our operations actually. So we are kind of a mid-layer team between our back-end team and the front-end team on the branch level or the ground. So what we decided is that the requirement of this team comes in because of the regulations. The complexity of the regulations is such that we cannot expect people sitting in the branches or people like RMs, they will not be able to handle most of the queries in such transactions because of the regulatory heavy nature. That's why this team has been set up. And most of the team members within Structured Solution and IDFC are experienced in handling these transactions in their various roles in the prior banks. So I come from a private sector bank, as sir had introduced, 11.5 years I've worked in the same area, foreign direct investment, ECB and ODI. So by now, at least some semblance of knowledge I have, which I thought I would share it with you. But recently also there are a lot of changes going on. As you will see on the screen, new OI framework, overseas investment. So since FEMA came into picture, FEMA 99, the regulations which were governing the overseas investments have not been changed. So it was 22 long years, the regulations were same. All other regulations were getting changed, but OI regulations, for the first time, they underwent a change on 22nd August 2022. Okay, the draft regulation had come in 21. After 1 year, they came out with these new regulations. Still, there are a lot of issues in this, but we thought we will share it with you, some of the key changes. You might be knowing the earlier regulation, right? But there are certain changes which have undergone in these regulations, which will be helpful to you to know, to have an understanding. So we'll try to cover our discussion on these topics. First and foremost is round tripping. So this round tripping aspect came into limelight in 2016 when suddenly RBI one day said in an FAQ that round tripping is not allowed. Round tripping for uninitiated is you doing an ODI outside India and the same money coming back to India, which doesn't look bona fide, which is not bona fide actually. So RBI said no. So for the first time in FAQ, they clarified it. The law always prevented it. People managed to do it, but law always said it is not allowed. So if RBI had, somehow it came to know that there is a round tripping structure, they used to compound that matter, heavy penalty. Otherwise, they would always say that you come under approval. You make an application to it, we will approve it, then you go ahead. But people used to do it and then they used to go to RBI. So matters were compounded immediately by RBI. But for the very first time under the new regulations, they are allowing round tripping, but subject to certain conditions. So we will try to understand this, with certain examples, which RBI themselves had shared with the AD banks, right? So rule 19.3 of the OI rule. So there are 3 regulations which are currently governing overseas investment. One is rules, overseas investment rules. One is overseas investment regulation. And then there is a master direction on overseas investment issued by RBI. OI rules is given by Ministry of Finance. Regulations are given by RBI and master direction is also issued by RBI. Now, most of the powers for framing the law is with Ministry of Finance, not with RBI. Earlier, RBI used to make law, they used to come out with APDI, circulars, and everything. But going forward, it will be all gazette notification from Ministry of Finance. Any change in this OI rules will come from Ministry of Finance, not from RBI. Although they have delegated the administrative powers to Reserve Bank of India. So RBI will be hearing the cases and all, that's fine. But the changes in law will come from Ministry of Finance. So Rule 19.3 of OI rules says that, no person resident in India shall make financial commitment in a foreign entity. Financial commitment means investment, right? That has invested or invests into India, right? At the time of making such financial commitment or at any time thereafter, either directly or indirectly, resulting in a structure with more than 2 layers of subsidiary. This is very critical to understand what do they mean by 2 layers. This is not something we understand in other corporate regulations. Like this is very unique to FEMA itself. So what they mean by is that suppose there is a company in India, ABC Private Limited, which has done an investment outside India in US, right? It has complied with all the regulation requirement. It has taken the UN, it is filing APR, everything. Now this US entity has a subsidiary in Mauritius and in Singapore, right? And this Singapore entity wants to do an FDI in XYZ Private Limited India. It's a different company. These are not group companies. It's a different company altogether. So ideally, prior to 22nd August, this structure was not allowed. Although people managed, from one bank they used to do ODI and from another bank they used to do FDI. That is how they managed. But ultimately, at the time of reporting, it used to get caught. But now they are saying that this structure can pass. This structure can be done, undertaken. You can do an ODI like this and come back to India because here the 2 layers will start from Singapore entity. Singapore entity in which the investment is there, the step down subsidiary, that will be counted as layer 1. And the proposed investment or FDI into XYZ Private Limited will be counted as layer 2. So this structure will be compliant with 93. Of course, it should be bona fide. Bona fide is the overreaching principle in OI rules. Whatever you do, whatever structuring you do, even if it is compliant with other regulations, it should be bona fide. So if it is a bona fide transaction, there is a business need to come back to India and invest. In certain sectors, it is a requirement, genuine requirement like pharma and all. Then this structure is okay. You need not go to RBI for approval. They have permitted this structure now. But the same example, if I take, Singapore entity has invested in Luxembourg, right? ABC company. And that Luxembourg entity wants to invest into India. In this scenario, if you see layer 1 is Singapore, layer 2 is Luxembourg, and the proposed investment will be layer 3. So layer 3 will not be permitted by Rule 90. So this structure will not fly through. You will have to go to RBI and take approval. Whether approval will come or not, that is up to RBI. We will have to represent the matter. So we understand the structures will not be this simple in real life. It will be like a lot more complicated. But if you're breaching the two-layer structure, you will have to go to RBI, and most probably RBI will want you to break down the structure and come within this. Initially, they'll say you sell some of the investments you have outside India, come within this rule and be compliant. Right? This will be the initial. Of course, if you can say that it is not possible or something like that, then it is up to them to decide and see whether to approve it or not. Initial reaction from them is that they will not approve it. 95% of the cases they don't approve. This is our experience with RBI. Prior to even 2016, we had taken 2 approvals from them after a lot of deliberations, after a lot of writing letter to them, sitting with them, explaining them along with the customer. Then they approved it. One for pharma sector and one for hospitality sector. But generally they are reluctant to approve any kind of structure which involves flow of funds from India to outside and from outside to India again. They deem it as not bona fide, primary facing. But only in Rule 19.3 now it is permitted. So we'll have to be cognizant of this fact whenever you are going to RBI or whenever you are doing any investments outside India. And one more important thing is that in the previous example, I forgot to mention, suppose this structure is allowed, right? This is 2-layer structure. Now suppose this XYZ Private Limited is a foreign owned and controlled. Suppose 51% or more equity of this company is owned by non-resident. It is deemed as a foreign owned and controlled company under the FDI regulations. Whatever investment XYZ Private Limited does, even in India, further investment, it will not be possible because there is a ODI structure initially. So downstream investment, although will be permitted under NDA rules, because of this rule 19.3 under the OI rules, downstream investment further will not be possible for XYZ. So if you are advising your client, which has a ODI leg in its corporate structure somewhere, you will have to be cognizant of this fact. So both there is an interplay of FDI rules as well as OI rules now. They are not standalone rules no longer. Many of the definitions under OI rules come from FDI and from the Companies Act. So if you are doing any kind of structuring for your corporate, be cognizant of this matter. Any questions on this? I can take it now, or you can have a Q&A later. If it is now, of course, it will be good for the benefit of all. If any member has any queries on this, because this is something new, we are also grappling with it, how to do it. But this is very interesting. Yeah. Yes, sir. Yeah. So I will come to that. So how holding and subsidiary relationship comes. So in the new regulations, they have for the very first time defined what is ODI, what is OPI. In the erstwhile regulation, there was no definition of portfolio investment. For the very first time, they have defined what is ODI, OPI, and they have taken the definition verbatim from FDI regulations. In FDI, we have FDI and FPI, right? Same definition they have copied here. So whatever investment you do in an overseas entity which is unlisted, even if you take one share, that is deemed as ODI. You will have to comply with all the guidelines. LRS route is no longer available. So even if you take one share of any unlisted company outside India, you will have to fall within these regulations. Yes, sir. I will come to that ESOP. I have covered ESOP slide on that. That there is a change there. And if you are investing in a listed company up to 10%, it will be treated as portfolio. So anything you invest in a stock exchange outside India up to 10%, fine. It will be treated as portfolio. There is no reporting per se now for any portfolio investment. There is a form OPI, but that is not for individuals investing in a listed company outside India. That has a different purpose. I will come to that. So these are the two overreaching definitions. If you are investing in an unlisted company or a listed company outside India more than 10%, those two are ODI. You will have to comply with the host of the regulations, including this.
Investment can be under LRS, no?
The LRS window is totally closed. As a resident individual, your limit for investment will be tagged to that LRS limit, $250,000 per annum. Otherwise, you cannot invest in any other security under LRS. Yeah. Previously, it was allowed. From 23rd August, it is gone. 23rd August 22. It is already gone.
If the investment
That's okay. Those will continue as it is. Those will continue. I will come to that, sir. It's interesting. Gift City, because of development focus of government on Gift City, there are different set of regulations. I will come to that. Yeah. Valuation is now kept to the AD banks purview. So as per the board approved policy of each AD banks, they will come up with their own policy. Most of the banks, as we know, including IDFC First Bank, have adopted the same policy which was there in earlier regulation. Up to $5 lakh, if the investment amount is up to $5 lakh, we insist for a CA certificate, CA valuation certificate or a CPA valuation certificate. If it is more than $5 lakh, we insist for a SEBI registered merchant banker certificate.
And in terms of the investment part, if a foreign investor is coming, you
Yeah.
have to price at the maximum. Then there is a difference in the FEMA and.
I will tell you, sir, one rule. Of course, this is outside the purview of this topic, but I will tell you what the underlying guidelines of pricing mechanism is that. See, it is a conservation of foreign exchange, right? The principle behind all the regulations in FEMA is conservation of foreign exchange. So if you are sending money outside India to anyone for buying anything, you cannot go beyond the valuation. Valuation from an independent party. That is the overreaching principle, both under FDI as well as ODS. If you are acquiring any company outside India, you have to first value that company, and you cannot send money more forex more than that, right? And if you are selling that entity to someone, you will have to bring either equal to the valuation or more than that. Any valuation, any internationally recognized method can be adopted. There is no hard and fast rule. It should be DCF or net asset basis, nothing like that. Even pharma companies are using some exotic valuation, which I myself have not seen. They value their IPs, intellectual property. I have seen some of the valuations, so I don't understand that. We generally understand DCF and NAV, right? But there are so many policies, the way to arrive at the value. It is sometimes confusing, but we have to, if independent valuer has given, then AD Bank has no choice. We have to accept it. Coming back to another important thing is deferred consideration. So deferred consideration means you are making payment in installment. Generally, earlier regulation didn't allow for this deferred considerations. If you are acquiring, say, 100 million shares, you will have to make the payment upfront. Or if you are making, say, 50 million, that 50 million worth of shares should be bought back. Now, for the first time, RBI has allowed deferred consideration. You can make payment in installments. Literally. Earlier regulation didn't allow this. The only requirement here is that you will have to make pricing guidelines compliance will have to be done upfront. So whatever price you decide now, say 100 million should be less than or equal to the fair value of that company, which is certified by any CA, CPA or SEBI registered merchant. After that, you can decide the schedule. In what schedule you want to make the payment. Say 50 million now, 50 million after 5 years. Fine. Anything is possible. Unlike in FDI rules where there's a limit, only 25% can be deferred up to 18 months. That restriction is not there under ODI. You can practically defer whatever amount you want for whatever period of time. The only requirement is that you make an agreement to that effect, specify the schedule there, and comply with the pricing schedule. Important point to note is that you need not again and again give the statutory auditor certificate with each and every installment payment. Only section A and B and C will be enough. No need for giving auditor certificate for every tranche payment. So what happens is that 100 million I will report to RBI in my system, whichever is there between RBI and AD banks. 50 million will be reported as a fund-based exposure, which is set now, and 50 million will be reported as deferred consideration. So tomorrow, if you come and change that schedule, then I will have to go to RBI. But if you stick to that schedule, I will process the transaction under automatic. So that is the only, these are the requirements. If you are deferring, there's a deferment involved in your investments. Yeah. So this is where GIFT City angle will come in this part. Investment into financial sector outside India. So general rule is that resident individuals are not allowed to invest in financial sector. For the very first time, they have come out with a regulation where they are allowing resident individuals to invest, but in GIFT City only. I will cover that. But for a corporate entity, for a corporate entity who is into financial services in India, if he wants to invest outside India into financial services, so those three conditions, the 3 years profitability track record, local regulator approval, and overseas regulator approval, all the three conditions which were there earlier, same conditions will apply, but with a slight change. If the overseas regulator does not require any kind of registration in that country for that financial services activity which Indian party is going to undertake, then there is no need to go to RBI for approval. You can give a legal opinion or an independent CPA opinion saying that in that country, the financial regulator does not give registration for this proposed activity, we will go ahead. Earlier, we used to run to RBI for seeking approval. That anomaly is now removed. So that burden from RBI has been removed. If you give us an opinion of that effect, we will be okay to do it. Otherwise, all other conditions will prevail. And if you are investing in GIFT City, Gujarat, then that GIFT City regulator has to give you approval within 45 days. If it doesn't give approval, then it is deemed as approved. You can go ahead with your investments in GIFT City. So that leeway has been given only for GIFT City. And if you're a corporate who is into financial services sector, wants to invest in a non-financial service sector, under OI rules and under FEMA, there is no restriction. But if your local regulator like IRDA or SEBI or RBI DNPS comes up with any regulation requirement for investing in a non-financial services, then those things will have to be followed. Under OI rules, there is no restriction or no requirement, additional requirement. And if you are a corporate who is into a non-financial and if you want to invest in a financial services sector, then banking and insurance is prohibited. Other than banking and insurance, any financial activity you can take outside India. And the only condition is 3 years profitability track record. And if you are in Gift City, Gujarat, if you want to set up a financial services activity in Gift City, then that 3 years profitability track record is also exempt. So that exemption has been given to promote Gift City. This is all about the corporates who are investing outside India in financial services. Right now, coming back to individuals, there are 2 ways. If they are not investing in Gift City, they are not permitted to invest in financial services. Only and only Gift City, where a financial services entity is set up, in that resident individuals can go and invest. Right. And there are 2 aspects to it, whether with control or without control. Now, there is a definition of control under OI rules, which mimics the definition of Companies Act to some extent. But there is some slight change. So if you are holding 10% or more equity in any entity outside India, by default, it is deemed as control. But if you are holding less than 10% equity, but with some management rights or something, then it is deemed as control. So control definition is a little expanded in OI rules. So if you are investing in an entity in Gift City beyond 10%, then it becomes a controlling entity. In that scenario, that Gift City entity cannot come back and invest again in India. And if you are investing less than 10%, then that Gift City entity can even set up an entity in India. So money can flow from here to Gift City and from Gift City to here. But if you are have a controlling stake, then that Gift City entity has to go outside India. It cannot again come back to India. So for FEMA purposes, Gift City is treated as a normal non-resident. Anything you send to Gift City will be in dollars only. Anything received from Gift City will be only dollars. No INR is permitted. So we will treat, for FEMA purposes, Gift City as a normal non-resident entity. Of course, with these guidelines, special guidelines for promoting Gift City. Otherwise, if as an individual, I cannot invest in a financial entity anywhere else. So that's why we see a lot of activity in Gift City where funds are trying to set up their shops so that they can attract HNI investments from India. Because otherwise, for an HNI in India, the LRS route is closed now. I have to go set up fund in Gift City, send the money there, and from Gift City, I can send it anywhere. That is the only route now available. So any questions on this? I think somebody was asking for financial services, Gift City. So this is what is all about Gift City investments in a nutshell. Non-fund based commitment is all about your guarantees, corporate guarantees, bank guarantees, pledge of shares, charge on assets, which was allowed earlier also, but with many restrictions actually. Earlier regulation, didn't allow banks to issue guarantees on behalf of step-down subsidiaries, and corporates can issue, were required to issue guarantees only up to step-down 1, SDS 1. Now the new regulations have removed those restrictions. You can approach a bank for giving any kind of guarantee to any level of step-downs outside India. No matter whether it is 1, 2, 3, 4, nothing. So you can give bank guarantees, you can give corporate guarantee to any level. You can create a charge on your assets for benefit of your subsidiary step down anyway. And one more change is that if you are giving, generally the norm in the international market is that if you are taking a loan, 100 million loans, for example, you are supposed to give security in over and above the facility. So generally they will ask for 150 million guarantee or 150 million pledge. So earlier we used to block the entire 150 million as financial commitment. There is a limit, right? 400% of the net worth for doing ODI by corporate. So if you block more than the facility amount, the 400% limit gets reduced. Now what they have said is that if you give any such thing, which is over and above the facility amount, that commitment will be restricted to the facility amount. So if you are giving 150 million guarantee or security in against a 100 million facility by your subsidiary, the financial commitment from India will be counted only 100 million, not 150 million. So that eases your availability of the limit 400% for doing other investments outside India. So that is one important change which they have undertaken the new guidelines. ESOPs, I think somebody has asked ESOP. So this is very interesting because earlier ESOPs were not covered under LRS. to some extent. Some banks are blocking LRS limit, most of the banks are not blocking the LRS limit, and they were sending the ESOP. ESOP means Indian employees investing in shares of overseas companies as ESOP, employee stock option. Now in ESOP, the general rule of ODI and OPI doesn't apply. The definition which I just quoted a while back, listed entity up to 10% OPI, anything in an unlisted company or a listed company about 10% ODI, that definition doesn't hold good in ESOP. In ESOP, you will have to see what is the percentage stake being acquired by the individual employee. If it is less than 10%, irrespective of whether it's a listed or unlisted entity, straight away it is OPI, portfolio investment. And if it is above 10%, it becomes ODI. Now, why this distinction is important is that the guidelines after this, the regulatory guidelines after this changes. The reporting guidelines or the regulatory burden will change according to this classification. If it is OPI, then it is very simple. The entity which employs that individual in India, the branch of the overseas entity, that entity has to do the reporting in form OPI. The individual employee who is subscribing to ESOP is not required to do any compliance. But if it is about 10% and it is ODI, then that individual employee will have to take UN, he will have to file APR, he will have to give the share certificate, all those things which a normal entity does when it invests. So the regulatory burden will change, whether it is OPI or ODI, depending on that. Right? And as far as limit is concerned, there is practically no limit to sending ESOP. You can send more than your LRS limit. You can send even $10 million under LRS limit. But for this financial year, your entire LRS limit will be blocked by the bank. And it will be reported to RBI centrally. So suppose you are coming to me with a $5 lakh request for sending ESOP. I will sell you the dollars and send $5 lakh. But your available limit for this current financial year under LRS will be totally blocked. So you will not be able to go outside India or use your international credit card, nothing. Because centrally all the LRS transactions are reported to Reserve Bank of India by all the 8 banks. So that will have to be taken care of, when employees are investing. Their LRS limit will be blocked, but they will be able to send more than that. So that is the new guidelines on ESOP, Indian employees subscribing to ESOP of overseas entity. So they will have to be cognizant that they are actually utilizing their LRS limit. Right? And if they exhaust their LRS limit in this fashion, then they will have to use the corporate cards for their spends. That is the only option. Any query on this? This is a landmark change. Anybody has any queries on ESOP? This is what the regulation states all about ESOP.
The
Balance will be available. Balance will be available. Yes. Yeah. 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 ESOP, you are talking about employee stock benefit scheme, not actually ESOP, but some benefit scheme. Yeah. Yeah. So if you are, general rule is that if you are getting any foreign security of an entity outside India, you being a resident in India will have to report that matter to Reserve Bank of India in form OPI. Your employee will report. You will not, as an employee, you are not required to report. Your employer will report it. No. If there is no actual outflow of funds from India, your LRS will not be blocked. But you will have to report that matter. Yes, sir. Employees. Correct. 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 Yes, sir. So company who is doing an ESOP payment, I understand your question because 20% is going to kick in from 1st July, 20% TCS. It is a lot of burden on the individual employees, but the employer will have to collect along with the TCS, the ESOP amount, give the PAN card or passport copy of that employee to the bank, and then bank will block those limits and send the money outside India. Yes. This is another interesting topic. So earlier regulations were actually very silent on this aspect. The only thing they mentioned is that there is a general permission to person resident in India to acquire securities under gift route. That's it. Full stop. There was nothing beyond that. What percentage can be acquired? whether it can be strategic, whether it can be portfolio, small, big, nothing was defined. So people used to structure their transactions where they took entire company 100% under gift rule, overseas company. But those were not treated as bona fide by RBI. If RBI came to know about this thing, they used to compound the matter. But for the first time, luckily, they have defined what shares you can acquire of overseas entity under gift route. Inheritance is totally allowed. So under gift route, now they have restricted the transaction only between relatives. Relatives as per the Companies Act definition. So if you can take shares of foreign entity as a gift from your brother, sister, whatever those relations are there specified under the Companies Act. You cannot take gift from an unrelated party. Earlier that was allowed. People have done that. So unrelated parties now it is totally closed. So gift is now allowed only between relatives. And if you are taking gift from a non-resident relatives of foreign company shares, then you will have to additionally comply with FCRA. Now our government has not, or RBI has not come up with any guidelines on what compliance is required under FCRA. Because as we understand, as we read FCRA, it is applicable only to specific type of entities and individuals in India. It doesn't apply to everyone. But they have not clarified as to how compliances can be ensured if you're taking gift of securities, foreign securities from your non-resident relatives. So as it stands today, as a bank, we understand that gifting of shares of foreign entities is permitted between resident relatives only, unless and until they come up with any clarification as to how to comply with FCRA. Because FCRA is governed by MHA and even RBI will not put its hands there. So they are saying that please be guided by whatever MHA says. So whenever that amendment comes, we will see how to do these transactions where gift is possible between two resident and non-resident relatives. As far as giving gift is concerned, that is not allowed. If you hold shares of any foreign securities, you cannot gift it to your relative outside India. Within India is okay. Outside India relatives, you cannot transfer securities, foreign securities. You can only take, you cannot give. That is the principle under OI rules for family. So if you have, so this regulation doesn't grandfather anything. The erstwhile structures, if any, have been undertaken by the entity where substantial stake has been taken by Indian residents under gift route. If you go to RBI, those will be compounded straight away. Because RBI, in some of the communication to some of the banks, have said that gift route is available only for, not for strategic acquisitions. You can take small stake, 4%, 5%, up to 10%. But if you go beyond that and have taken foreign securities at gift, they generally compound it. So that is how it stands as far as gift is concerned. So many structures are floated, but those will be non-compliant because of this. So the standard definition under FEMA Act, there is a FEMA Act section 2 defines what is person resident outside India. The same definition apply. Income tax definition doesn't apply here. So period of stay in India previous year matters, or your intention to go outside India for study, business. If you are going that way, then immediately you become non-resident. But if your period of stay is that many days in India, then you become resident. So you will be guided by that definition, not income tax. That definition is very important because sometimes people invest and they become non-resident for some point. Then they don't have to do anything. They will have to just cancel the UI by writing to RBI if they don't have any intention to come back to India. And if they have done any investment outside India when they were non-resident, and if they come back to India, they need not comply with this. They need not go to RBI and say, I want an UI, unless and until they make further investments from India. So that section 6 will govern of FEMA. It says that you can hold on to your investments, money when you are resident outside India. That definition, that will prevail, that regulation will prevail. You need not go and take UI and file APR, no. Unless you start doing fresh investments again in that, when you come back to it. So there is another important enablement given by RBI because there are a lot of regulatory filings pending with RBI because almost I think 30,000 UANs are there with RBI, more than that in fact, and more than half of them are non-compliant. They are not submitting annual performance report of their subsidiary or something, some other issue is there. So RBI has come up with this window where they are saying that you have 3 years window, right, to regularize your non-filings. This late submission fee is only for regularizing the filing aspect, not breach of any guidelines or regulation. If you're breaching any regulatory guidelines, then the only leeway available to you is go for compounding through your AD bank. Don't directly go for compounding to the SEFA cell. go through your AD bank, because if you go directly to SEPA cell, they will reject back the case saying that we want AD comments. In case of ODI, AD has been placed as a center of information, or any application you want to do to RBI for OI, you will have to route it through AD bank. Otherwise, they will revert it back to AD saying that you come through AD bank along with their comments. So SEPA doesn't directly entertain any application for compounding under OI directly. No, it has to come through AD bank. So this window has been given only to ratify your non-filings of APR, share certificate, or any investment you have done which is not reported to RBI, those kind of things, right? And this responsibility for the first time under OI regulations is given to regional offices. Generally, regional offices of RBI don't come into picture in as far as cross-border investment outflow is concerned. So this is for the first time the regional offices have been granted powers to administer the regularization of filings. So depending on the starting 2 digits of the UIN which you take from RBI, your RO will get defined or tagged. So any APR you submit late or anything you submit late to AD bank reports it, writes to these regional offices. These regional offices will come back to you with an late submission fee amount and say that you paid through a DD mark to Reserve Bank of India. Once they do it and once you pay the DD to them, then that matter will be regularized by them. You need not write to them that AD bank and ROs will do, but anything up to 3 years non-filing can be regularized using this window. So any non-filing up to 22nd August 2022 can be regularized up to 21st August 25. But anything beyond that, if you're say current year you are filing it with a delay, you will get 3 years period. So that is the window. So if you have a non-filing of say 2010, you can regularize it up to 25. But if you are filing late of 2023 APR, you will get 3 years only. So that is how it will work. This window will work. It's a good window. You will have to pay minimum 7,500 per filing delay. Of course, that amount will multiply depending on the time period. So if you go for compounding, your penalty will be more than that for sure. There are other key changes also. For the first time, they have added the NPA concept. So earlier regulation said that if you are investigated by any regulatory agency in India, then that is investment cannot be done under automatic without the clearance of that investigating authority. Now they have added NPA to the list. So before sending any overseas investment, we will check whether any bank has declared that party as NPA. If yes, we'll have to take NOC from that bank, which practically will not come. Right? So NPA has been added to the list. Second is about sending intercorporate loans to your subsidiary outside. Right? There were no guidelines earlier. There was no restriction. Practically, you were able to take even 1% stake and send millions of dollars as a loan to your overseas subsidiary, interest-free also sometimes. But both things have now been capped. So you can send loan remittances to your subsidiary outside India, provided you have control, means more than 10% equity stake. And you cannot send it interest-free. You will have to price it on an arm's length basis. So you will have to take certificate from some CA or CPA, certifying that whatever pricing you are charging for that intercorporate loan is on an arm's length basis. AD banks cannot tell you that because it's not our area. It is something relating to taxation, we understand. So the Indian party who is making any loan remittance to their corporate will have to follow these two things: more than 10% equity and arm's length pricing. It cannot be interest-free loan anymore. You will have to charge interest and recover interest from it. Net worth definition now has been aligned with Companies Act. So securities premium balances can be included in a net worth. It helps you because the limit is 400% for corporates. So that helps taking that, because as well there was some ambiguity and we used to go to RBI for approval. Now it is brought into the net worth definition. As I said earlier, even if you invest one share in an overseas unlisted company, it becomes ODI. You will have to do all the compliance. But to ease out the pain for small investors who are investing 1% and 5% in an unlisted company, they have said that if you are investing up to 10% without control, then you are exempt from submitting APR. This is the only exemption available as far as APR submission is concerned. For all other guys who are investing with control or beyond 10%, they will have to file APR every year by December 31st. That is the deadline for filing annual performance. But if you are a small-time investor without control, you are exempt from submitting APR, which is an important exemption for them because they may not be able to get hold of the balance sheet and financials of the overseas entity to submit APR. Because for submitting APR, you require the audited financials. And being a small-time investor, they may not be able to share it with you. There might be reluctance for that. So that's why the exemption has been provided. Non-pendency has to be ensured yuan wise. If you have multiple yuans with different banks, earlier we used to block remittances or financial commitment even if there was any pendency in other yuans. Now that practice is stopped. So anything you are doing, any investment you are doing in a particular subsidiary outside India in a particular yuan, we will restrict the pendency checking to that yuan only. We will not check other bank yuans. That restriction has been removed. Restructuring, you can undertake restructuring of your investment, provided you have investment for more than 2 years. So you have done your investment now. In 25, you can undertake restructuring. Before that, you can. So you can do a valuation of that company. If the value has come down, you can bring down the value in your books also. But the loss arising on restructuring has to be borne equally by the partners. So suppose you have invested along with a foreign partner, right? The loss arising on restructuring has to be borne by both of them, not just by one party. By both of them in the ratio of their investment. So if you have done investment in equity plus loan, he has done only in equity, the loss arising on restructuring has to be borne in the amount of interest plus loan, equity plus loan plus his equity. Not in the ratio of their capital contribution, but in the ratio of their investment. So this is the only requirement if you are undertaking restructuring. Erstwhile regulation said you can restructure only up to 25%. Beyond 25% required RBI approval. Now they have done it free. Up to 2 years, beyond 2 years, you can undertake restructuring. Even 95% also restructuring you can do. No restriction on the limit. LSF we discussed. Individuals can now invest in equity, any kind of equity. CCPS, CCDs, all instruments. Earlier regulation said only equity and preference shares. Now they have come up with a guidance saying that you, as an individual, you can invest in any kind of security, which is perpetual capital in nature. So all those investments are now open for individuals. Bona fide, I said, any investment you do outside India has to pass the test of bona fide. So whenever any investigation comes up from any authority, RBI or ED, first thing they ask is whether it is bona fide. To AD bank, we will have to certify first. Then they will go to customer and ask whether it was bona fide. So this principle is there, it will always be there under OI. So any structuring you do, any investment you do, will have to conform to this bona fide. It's very important in case of OI. Yeah. Sorry, Karta is? No, sir. In OI, only 3 types of entities are allowed. One is private limited company, public limited company, registered partnership firms, LLPs, and resident individuals. Trust, societies, Kartas, HUFs are not allowed. So Karta will have to do it in his individual capacity under LRS. Yes.
Has to be the official gift city, the funds are typically for 17 to 10 years.
Yes, sir. So if you are investing in units of any fund outside India, whether gift city or otherwise, as an individual up to LRS limit, you can invest, provided you get units for that. It is allowed. Sorry? Units. Yeah. You cannot participate in the capital of a fund. Units can be issued. Fund units. Suppose there are certain funds who don't issue units. They will give something like it's a profit share or something. Right? So that things are not allowed. If you are getting units against your investment, you are allowed to do it. Initial corpus, if you are getting units for that, fine. Yes, sir. Yes, sir.
Can we inquire with the AD bank whether the investment which the particular
Sir, actually, bona fide means, I am not Antaryami, so I cannot detect what is your intention behind doing OI. Of course, we can only draw inferences from your KYC documents. You know, what kind of activity you are doing in India. What is your proposed activity outside India? We can only judge from that, and we can ask questions to you. Of course, it is up to customer whether he wants to do investment for genuine business expansion purposes or for otherwise. Sir, we are completely liable as far as forex outflow is concerned. Under FDI, we are not liable. It is up to customer. But when it is a matter of sending foreign exchange, we are equally liable along with customers. So whenever any investigation happens from ED, we are sitting there first. Well, whatever, chartered accountant, they will call everyone. Even if I have resigned from IDFC, they will call me. So I have faced that. So we are not escaping from that. They will call us also, definitely. So they are very strict as far as outflow of fund is concerned. In case of FDI, generally we don't see that many investigation happening, but for OI it is very frequent. Because this is sometimes misused a lot of time to send forex outside India. Anybody else before we move on to FDI? Actually, little small slide on FDI. That's it. Because this is something new. That's why I touched it upon first. FDI has now become a little old now. 3 years gone. The regulation has. Yeah. Yeah. Yes, sir.
In Indian context or overseas context?
Sir, not clarified by RBI, but what we understand, it will be in the overseas context.
Because LIBOR plus is not.
LIBOR to gone now. So you will have to do SOFR, SONIA, whatever those alternate rates are there. Whatever the banks charge there, you will have to somehow come up with the intelligent way of saying, certifying that it is an arm's length price. They have just given a same principle, but how the pricing will be between unrelated parties, the same principle applies. So you will have to certify that. Yes. Partnership. Partnership, I doubt. Go ahead. Correct. So, sir, whenever, I don't know, see, generally when a bank is sending money outside India for investment purposes, they will ask you for a host of documents. There is a separate form called Form FC. Earlier it was called Form ODI. Now it is called Form FC. They take that entire form from you. You will have to declare what is your line of activity, activity code, your financials, the section, different section will cover details of the overseas entity, what is your profit percentage or capital contribution. All these things they ask, they report it to RBI, they generate a UN. It's an alphanumeric UN, which RBI used to track all the investment going outside India. You will have to take that UN. You also give your email ID, right? In forms, there's an email ID column. Whatever email ID you give there, in that email ID, you will receive a communication from the RBI's website saying that this is the investment you have done. This is the UN. These are the obligations you will have to fulfill for this. So if you have not done that and money is coming back on this investment, AD banks will not do it unless and until you regularize this matter. You will have to now go to RBI, apply for compounding or whatever, regularize the matter, file all the annual performance report, and then it will be okay. APR every year. So UN is like, it is taken when you initially invest. Subsequent investment will be reported in the same UN to the same entity. If you are investing in another entity, you will have to take a different UN. So it is entity specific. No. So investment which goes from India. So you see, I will again tell you, you cannot go outside India and swipe your credit card or pay cash for making overseas investment. Those are not permitted mode of investments. Only permitted mode of investment is sending money from India to outside through banking channel. No, sir. That is a violation of the guidelines. 3 years window is not available. You will have to report that matter along with forms to AD bank. They will write to RBI, report it under approval route. Once RBI ratifies it, you will get a UN. Then you will have to submit all 5 years APR or 6 years, whatever is. So if UN is not there. If UN is generated, all APRs are submitted, then AD bank will be okay to process the transaction. Yes, sir. NRIs generally, if they invest outside India from their foreign funds, they don't come under this regulations at all. They are investing from their NRE account or whatever overseas account, they don't come under purview of this OI regulations. Sorry. I will come to that. I think you are speaking about FDI regulation when they invest in India. I will come to that. So we'll just start with foreign direct investment. Not much, I will tell you, but these are the guidelines which cover the foreign direct investment into India, right, from non-resident. So one is first and foremost is their FDI policy, which governs all the foreign investments coming into India. Next, there is non-debt instrument rules issued by Reserve Bank of India along with Ministry. Along with that, there is another regulation called mode of payment and reporting of non-debt instruments. Basically, how can you receive money into India under FDI rule and what reportings have to be done, which is governed by that regulations. And of course, there's a master direction by Reserve Bank of India. Along with this, frequently they come up with gazette notifications. So you will not get APDIs now from Reserve Bank. You will have to see the gazette notification of India for any notification issued under FDI policy, FDI guideline. So any policy which is issued by DPIT as a part of FDI policy, any change that has to be notified under gazette, then only it takes effect, right? So you will have to see all these guidelines to really come up with the compliances of the foreign direct investments received in India. So if I'm talking about NDI rules or FEMA 20R, which you guys know from earlier times, or FEMA 20, so 20R and now NDA, this is the sequence. So the entire regulation is split up into 10 schedules. So these are the 10 schedules under NDI rules in which FDI can be received in India. So if you see the first schedule, which is frequently used, foreign direct investment, where unlisted companies receive FDI from outside India. So that is the schedule 1 which governs those investments. Schedule 2 talks about listed entities receiving investment from foreign portfolio investors. So foreign portfolio investors up to 10% they can invest in India in listed companies. So those investments are guided by schedule 2. There is no, the reporting for those kind of portfolio investors is different, and those being issued by unlisted companies is different. So that's why there are 2 different schedules, and the manner of receipt of payment and reporting changes accordingly. Similarly, 3rd and 4th schedule talks about NRI investments. NRIs can invest in India. NRIs and OCI cardholders can invest in India under 2 rules: repatriable basis, non-repatriable basis. Generally, they don't declare whether it is repatriable, non-repatriable. Only at the time of disinvestment, we come to know that investment has been done by NRI OCI. But listed companies do maintain a separate ISIN number for repatriable and non-repatriable. There it is very easy, but for unlisted companies, sometimes they get confused. So if your NRI is investing on a repatriable basis, it will be like a normal non-resident investing. Money will come either from their NRE, NRO account or from outside India, and they can take back their money on the sale of investment. We will report the matter in a normal fashion, form FCGPR, FCTR. But if it is a non-repatriable investment, they can bring the money under NRE, NRO account. There is no reporting attached to the non-repatriable investment. You have to just give a declaration to the bank saying that this is a non-repatriable investment. That's it. There's no reporting for it. But when they are exiting their investment, when they are selling their investment, they can take back that sale proceeds only to their NRO. As a bank, I will not be able to send that outside India. You will have to credit it to the NRO account, and whatever profit is arising on the sale, that he can take back outside India. Generally, people don't watch that, but if you see the mode of payment guidelines, they have said that you can take back the investment only to the extent of profits you have made on the investment. But banks are generally sending under 1 billion. That is what the practice is. But this is what the NRI investments are. Other non-resident investments are strategic investment by government level funds into India that we don't encounter very frequently. 6th is your LLP investment. Even LLPs in India can receive foreign investment. So it works in the same fashion, only the reporting part is different. Instead of filing FCGPR and FCTRs, we file LLP1 and LLP2 there. Otherwise, they are also eligible to receive FDI in India. FVCI and investment vehicles are specific SEBI registered vehicles in India. FVCIs are permitted to invest in 10 categories of sector, in 10 sectors in India. And they can issue any kind of instruments, not just equity shares, even OCDs, NCDs, any kind of instrument. So their pricing guidelines doesn't apply for FVCIs because the intention of the government is to promote those 10 sectors. So they can bring money, they can take back the money irrespective of the valuation. But for others, it is not the scenario. For other schedules, you will have to comply with the price. Only for FVCI, it is not. Investment vehicles are SEBI registered AIFs, Cat 1, Cat 3, who can receive money from outside India. There, the reporting is a little different. And the last 2 are talking about ADR, GDRs, and IDRs. Again, that is not very frequent. We don't encounter IDR issuance and ADR, GDR issuance, but there is a separate set of guidelines governing FDI received under DR schemes. So this is what the snapshot is. We will share. Of course, this is with you. You can refer to this anytime. Any investment coming into India will have to be classified at either of these 10 schedules. And depending on that, your other things will follow. Yeah, yes, sir. Yeah. OCI card holders. Yeah. And they are separate category of non-resident investors. They carry that OCI card, which is like, it looks like passport only, but they have a separate card called OCI card holders. Normally, same, the treatment is same for FDI. The same thing continue. See, generally, this second one is important. Whenever a foreign direct investment is coming into India, it can come only from NRE NRO account, or from a remittance outside India, or from their SNRR account. If it's a portfolio investment, they can even use SNRR account. Other modes of investments are not permitted. So don't ask your investor to send through a cloud payment, PayPal, or using 82 bank services like money changers and all. It is not possible to receive money. Even if we receive money, it is not possible to do further reportings of FDI to Reserve Bank of India, because any FDI reporting to RBI requires a 6-pointer KYC on the investor. If you're sending money through cloud payments or through money changers, 6-pointer KYC of the investor never comes. That is our, in practice we have learned. It never comes. Even if I have credited it, he will not be able to report it to RBI. And if you don't report it, it is a non-compete. So at the time of exit, it will be a big problem for him. Because he doesn't have the reporting acknowledgement, we will not be able to send the money back. So try to ask your investor to send money only by talking to your bank. Every bank has their nostro arrangement, right? All the banks have the US nostro arrangement. You'll have to route the funds to that only. You cannot send cloud payments or money changer payments to India. Similarly, the filings, each schedule will have its own different set of filings. General understanding is FCGPR and FCTRS. But depending on if it's a FVCI investment or if it's an AIF investment, the form changes. Right? For NRIs, it's the same form, but for FVCI, for AIFs and for LLPs, there's a different set of form. The timelines are a little different. I have noted down the timelines here. Most of the time, it is 30 days. In some cases, 60 days time is given, but general rule is 30 days. 30 days from the date of issuing the instruments, you will have to file those forms to Reserve Bank of India. And as you know, filing is online. There is no physical filing now. All the filings will have to be done online. Your entity who is receiving FDI will have to have an entity master in that forms portal first. If he has, for the first time, if he is receiving FDI in India, he will have to create that entity master. That process is between you as a customer and the Reserve Bank of India. AD banks are not involved. Once entity master is in place, you will have to create a business user, BU, as you call it. And then once you have BU, then you can start filing online. And there will be no physical communication either from AD Bank or from Reserve Bank of India. All the communication will happen on the mail. So sometimes we see that people submit it and they don't see their mail. Sometimes the AD Bank has rejected, sometimes RBI has rejected. They feel that it is filed, right? But you should receive the final acknowledgement from RBI. That is the end point of reporting. Unless you have received acknowledgement from Reserve Bank of India, you should not feel that it is over. It depends on case to case. Generally, the TAT is 3 to 4 days, not more than that. If everything is okay, it should not take even more than 3 days. That's why I said you will have to track your email ID which you give in your BU creation. So you have given a BU creation request and email ID you give, try to access that mail, every time. Or you can see in your login when you log in. But the end point is the receipt of acknowledgement from Reserve Bank of India. That becomes super critical when in case of exit. When you are exiting, when NR is exiting, he wants to take back the money. First thing AD banks will ask is that acknowledgement from Reserve Bank of India. And at the time when physical FCGPRs were filed, many people don't have that acknowledgement or they have lost it somehow. Either they will have to go to that regional office and recover the office copy, okay? Or if they have it, fine. If they don't have it, don't have any clue. They will have to refile it now with compounding. That is how strict RBI has become. Earlier, they were not very strict with the FCGPR regulations. Now they are not. Even if I am approving as a AD bank, they are rejecting it. from backend. They are monitoring it. There are other reportings actually, in addition to the reports which we have discussed. There is Form CN. This is only for DPIT registered startups. This is a hybrid instrument which they can issue. Only startups, not any other entity. For them, there is a special reporting for called Form CN. There is a separate reporting for ESOP also. So if any Indian company is issuing ESOP to foreign nationals who are employees of their group companies outside India, they will have to do two reportings. One is Form ESOP reporting at the time of declaring the ESOP. And when they exercise the ESOP, they will have to do normal FCGPR report. So there are actually two reportings in case of ESOP. And Form DI, which I just touched upon, is done by foreign owned and controlled companies in India. Many big companies are not doing this. So any company who has more than 51% stake from a non-resident, they become foreign owned and controlled company under FIM. So any investment they do, even in India, they will have to comply with the FDI policy. And they will have to do a special reporting in Form DI. So many people are ignorant of this. They seem that because investment is within India only, they don't do any reporting. But this reporting is required. Form DI reporting. It is called downstream investment. So any questions till now, we can go further. This is one of the important notifications which came in COVID times in April 20. So this talks about investments coming from land bordering countries. Especially it was targeted towards China because government didn't want Chinese entities to end up owning majority stake in Indian entities. So they came out with this regulation in April 17, I think, 2020. So it clearly says that if any investor is coming directly from land bordering countries, so these are the land bordering countries, right? And China will include Hong Kong and Macau. It will not include Taiwan. Currently, the situation is Taiwan is exempt, but it will include Hong Kong and Macau. So any investment coming from these nations directly, whether from an individual or an entity registered from these countries, the FDI will not be processed by the bank. Whether the FDI is in a sector which is allowed, still it will not be processed by the ED banks. They will ask you to take approval from Government of India, not even Reserve Bank. It goes to Ministry of Home Affairs. Actually, you have to make an application to FIFP. It is called Foreign Investment Facilitation Portal. It's an online platform. You will have to submit the application. Application in turn goes to Ministry of Home Affairs. And as we understand, most of the applications for investment from land bordering countries are not being approved currently. Most of them are getting rejected. But this is what is. So whenever an investment is coming into India directly from these land bordering countries, it is a no-go. And if the investment is coming from any other jurisdiction, say suppose it is coming from Singapore, every bank takes a declaration that the investing entity doesn't have any substantial ownership from these land bordering countries. So every bank will have a different guidelines for that. We also have a separate declaration, right? The overreaching principle is that the investment should not, the ultimate beneficial owner from the investing entity should not be from these land bordering countries. That is the overreaching principle. Now, how you certify it, how you give that, it is up to you. Because as a bank, I cannot check that, right? As an investing entity in India, you cannot check that. You will have to depend on your investor to declare it. So this is what it is. This applies only and only to FDI investments in India. It doesn't apply to any other form of funding. Like it doesn't apply to ECBs, long-term fundings. You can take ECB from a Chinese lender by complying with the ECB guide. But if you're taking a long-term investment, then you will have to be cognizant of this restriction. It is under approval. And the threshold which we apply for beneficial ownership is as per the Companies Act, 10%. There are certain banks who are following 25% limit, but that is now totally not acceptable. It is up to 10%. So if more than 10% investment in the investing entities from these guys, land bordering countries, that is a no-go. No FDI is allowed. And this has to be taken care of by the Indian company at every stage, not only at the time of receiving FDI, but even post receiving FDI. Suppose if there is any corporate action, right, which leads to Chinese investment going beyond 10%, then it will be a problem. If there is a sale transaction and the investment percentage gets increased, they will have to be cognizant of this at every stage.
One question here.
Yeah.
Investments coming from Asian infrastructure investment bank.
Yeah. AIB. I think AIB is a multilateral development financial institution. It should not apply to them. Yeah, but we'll have to see because we have not handled AIB. AIB generally gives ECB funding, long-term funding.
They also investing in the fund.
Yeah, we know that, but we have not encountered that. But AIB, we'll have to see because beneficial owner is actually not an individual there, right? It might be a government entity. We'll have to figure that out. If it's a Chinese investor, yes, there will be a problem. But generally, we have not seen them blocking AIB investments. Yeah. Yeah. Yeah.
The compliance regarding
Downstream investment.
downstream investment. Or you try to get to other form.
FCGPR. Last one is it's an indirect foreign investment. I will give an example. So in tobacco, FDI is not permitted. Tobacco is a restricted item. Even nuclear defense is a restricted item. So directly people are not allowed to invest. So people are smart enough, they will form a company which is where FDI is allowed. They will invest money there and that entity will invest again, say tobacco manufacturing. So you are indirectly circumventing the FDI policy. To cover those loopholes, they have come out with the indirect foreign investment guidelines. So what you cannot do directly, you cannot do indirectly. That is what they want to address with this guidance. So that's why they have introduced this reporting. So if your entity is majoritarily owned by foreigners, more than 51% owned by foreign entities or foreign nationals, you become a foreign owned and controlled company under FEMA. Not under other rights, only under FEMA. Those FOCCs, whatever investments they do in India, onward investment, they will have to file Form DI. If you see the form, it talks about compliance with FDI policy. In fact, along with this Form DI, they have to do reporting to DIPP also. That I have invested so and so amount in so and so company. Along with that reporting, they have to do this Form DI to RBI. So that is how government controls. So again, this slide talks about same entities, foreign owned and controlled. So generally, guidelines only talk about this, foreign owned and controlled companies transferring to non-residents their stake in Indian company or to resident. Pricing guidelines, whether applicable or not. But the reverse scenario, if they are acquiring, they are acquiring a stake in Indian company from say another non-resident, whether pricing guidelines will apply? Yes, pricing guidelines will apply. Although the transaction, from is originating in India, they are doing an outward remittance because the forex is going outside India. RBI wants them to comply with foreign pricing guidelines. It is not written in the guidelines. If you try to read the guidelines, nowhere it is mentioned this. But this is what practically is happening. Any entity in India which is majority held by PE investors are FOCCs only. Because more than 51% stake is coming from outside India or entities owned by foreigners. They become FOCCs. So if they are acquiring any further companies in India, they have to comply with these guidelines. They cannot send money more than pricing, whatever the valuation of the entity is. So this is not very apparent from the regulation, but you should know about this fact. Yeah, so ESOP, initially I said that for ESOP, there are, the guidelines say that there are two reporting. Form ESOP when you are declaring form ESOP to your employees, and once when you are exercising it, form FCGPR has to be filed. Basically, non-resident employees subscribing to Indian ESOPs. So, but in case of a listed company, generally listed companies come up with this structure where they appoint a trustee in India. They create a trust in India to manage the ESOP. It is a private trust, 5% of the paid up equity which SEBI allows them for ESOP. They park in that trust, and the non-resident employees will have to buy and sell the ESOP stake from that trust. In this scenario, the regular filings of form ESOP and FCGPR doesn't apply because the transaction here is between a resident trust and a non-resident employee. So whenever they exercise and they buy, they will have to file form FCTRS, not form FCGPR or ESOP. Similarly, when they sell, they will have to file form FCTRS. So this structure is unique to listed companies actually. Or for a normal non-resident entity for a resident entity who doesn't come with this structure for ESOP, they will have to do normal FCGPR filing and form ESOP filing. For them, that filing will come. So this filing is only for trust structures of ESOP. This is also not mentioned or covered anywhere in the guidelines. But out of practice and out of rejections and going to RBI for clarification, this is what the clarity has come. Right. So whenever your client is doing a trust structure for ESOP, he has to follow the FCTRS guidelines, not FCGPR. This I think we can skip FCTRS. So this is a little reckoner we have for you for your reference purposes. Whatever transfers we are trying to cover, like whatever transfers are allowed under FEMA, those we have tried to map here along with the conditions, whether they will have to meet the pricing guidelines, what filing they will have to do. Everything is mentioned on this sheet. You can have a look at it whenever you want to. This even covers the gift part. Generally, gifting is not allowed; it is restricted to $50,000. That also we have tried to cover here. And what filings have to be done. So it is not understood that when you are giving gift, there is a filing to be done in form FCTRS. Most people don't end up doing that. So if we have tried to cover this in this reckoner, you can have a look at it. This is what I said about firms reporting, the online reporting system. These are the 3 stages actually. One is entity master creation, one is business user creation, and then those forms will come. So this is how the entire structure of the firm's reporting architecture works. By now, I understand you guys have done this for long enough. And recently they have come up with a slight change in the forms portal where concurrent filing under a SIN number is allowed. Earlier, they used to allow only one reporting at a time in a particular SIN number. Whenever you create an entity master or business user, it is tied to the SIN number of that entity. So it used to allow only one reporting at a time. Now their restriction has been removed. So parallelly, you can do different filings for that SIN from different banks. It allows you to go ahead. Earlier, you used to block you for that. So now that concurrent filing is there. One more important thing is that many people don't understand that not always when FDI is received, there is a reporting. Sometimes for certain corporate actions like M&A deals, or for bonus issuance, or for rights issue issuance, also there is a reporting. Typically, we see that for bonus issue, they don't end up doing any filing because they think that no money has flown into India. They don't do any filing. But for bonus issuance, also FCGPR form has to be filed. So we have seen cases in IPO where people have not filed for bonus issue. RBI has compounded them. In one of the cases, maximum compounding of 1 crore was levied. Just because that guy has not done in 2014 a reporting for form FCGPR for bonus issues. So RBI is very strict now. Even for IPO cases, they are not budging their stand. You will need the acknowledgements of the FDAs in whatever fashion it has happened, whether bonus issue, rights issue, initial allotment, further corporate action. So if there is M&A, one entity in which FDI has come has merged with another entity, you will have to have that flow. You'll have to have all the documents. And suppose original NR has transferred it to another NR outside India. They are asking for form SH4. Although there is no filing for NR to NR transfer in FEMA, but they are asking for MCA filing. Okay. Even for buyback, they are asking MGT9 or whatever filing you do under MCA, they are asking for that copy. It is all mentioned in the forms portal. If you go to forms portal, there is a manual at the bottom. Download that manual whenever you are doing reporting because that manual keeps on getting updated. We never know if you have downloaded manual, 1 year back, it may not be same, which is there currently because they keep on changing or amending the declarations from the company or a company secretary or a chartered accountant. They keep on doing that changes. They even change the document checklist, right? SH4, MGT9 was not there earlier. Now they've added. So if you look at download the latest form, you'll come to know they're given the detailed instruction on that. And of course, AD banks are there to guide you in any of these process, PU creation, entity master creation, forms filing. Because as a bank, we have a dedicated desk for checking all the documents, whatever you do under forms portal. Most banks don't have. We understand that. And you keep on getting rejections from the system and then you get fed up with that. Right? Then you end up paying LSF because time limit is gone by that. Because every time you file and I reject it or a bank, RBI rejects it, it is deemed as cancelled. Whenever you file next time, it is treated as fresh filing on that date. So your counter will again start. So this goes on between banks and customers or professionals like you who are doing for the customer. So we thought that we will have a dedicated desk for that. So we do pre-vetting of the documents. That is a much safer solution, especially in a high value deal, where LSF might be huge. So these are our contact details. It's there. I think you've already met some of the guys. Akshesha is there and Mahesh Shinde is there from our local ground staff here. So you can reach out to them for anything. So the forum is open for Q&A if you have anything on this or any other matter. So if your foreign company has gone bankrupt, then close the UN by writing to RBI. Because if you keep the UN open, you will be obliged to file APR every year. If you don't file, again there is a LSF. If it is non-bona fide, you think that he has done a fraud and no longer your investment, you write off the investment in your books, write to RBI, close the UN. You can write to RBI, sir. No issues. You can go through your AD bank. Don't write it directly. Go through your AD bank. That is relating to investment.
Not the sum of.
Investment in securities. Even investment of some is governed by LRS guidelines. LRS guidelines don't require any kind of reporting, but for securities, yes. Yes. Sorry? Not NRI, not NRI. Anybody who has invested into India, you end up issuing rights shares or bonus issue to him as a corporate action, which you do for all the shareholders uniformly. You will have to do reporting. Although in case of bonus issue, there is no inflow of funds, you will have to report it to RBI in form FCGPR, which many people are not doing. Yes, ECB. ECB, you can anytime convert loan into equity. But you will have to comply with FDI policy. So suppose your lender is Chinese, you will not be able to convert into FDI because of that pre-3 guidelines. So both the guidelines you will have to be aware of before converting. Otherwise, you can, in fact, if you suppose ECB you have taken for working capital for 5 years, and if you think that you cannot handle the currency fluctuation for 5 years, you can convert into equity anytime, even within 1 month or even within 1 year. There, of course, you do all the filings here and in ECB guidelines. That will have to go to RBI and report the matter. You can convert, but you will have to go to RBI. Yes, sir. No, sir. No, to the extent of unlisted companies. If it's a listed company, like if an AIF is investing outside India, SEBI registered AIF, they have to take a special approval from SEBI for investing outside India. But for unlisted companies or listed companies for that matter, they don't need to go to SEBI.
Type of conversion of converting to preferred shares.
CCPS. CCPS and CCDs are covered under the equity instrument definition of FDI policy, FDI rules. So when you issue CCDs or CCPS, it is reported in normal FCGPR, but in addition, you declare the conversion ratio to Reserve Bank of India and the period of conversion. On that basis, if you see after reporting, your entity master reflects the fully convertible or fully diluted basis your equity holding. So there is no separate reporting for actual conversion of CCPs or CCDs.
Time of issue, which we are not reported that.
So that you have to report, not the conversion. You will have to report the original issuance to Reserve Bank of India. There is no reporting for conversion of CCPs or CCDs to equity.
So we are reported that the preferred shares conversion ratio we are not reported.
No. So then your entity master is wrong. So we'll have to first correct that entity master. Whenever you are issuing CCDs, CCPs, the conversion ratio is required to be mentioned.
At that time it was not.
It was there. It was there. People used to mention, some people used to avoid it. Now we'll have to correct it. But there is no reporting for conversion of CCDs or CCPs into equity. Even today, it is not. Sir? Yeah. Yes, sir. Even if an IPO, OFS IPO is there, where non-resident is exiting, you will that non-resident will have to have all the FDI acknowledgements with them. Without that, because even if you're doing OFS, that has to be reported in form FCTRS post IPO completion within 60 days. At that time, I will have to attach all the reportings of Reserve Bank of India, certifying that it is complied with the FDI. Without that, so the penalty which I said 1 crore, it was actually an IPO deal. Where OFS was there, non-resident was exiting, but for bonus issuance, they have not done the reporting. That money will lie in the collecting bank account till the time it is regularized.
Sometimes on that we have the money is
No, sir. If it is an NR account, it is not required to report anything.
and again that AF is invested in any bank.
Yeah.
Say, then listed bank.
Yeah.
Then any reporting or any.
I think those are guided by the DNBS guidelines of DBR guidelines of RBI. We'll have to follow those guidelines. In this general guidelines, it is not there.
Any specific restriction for NRO investment.
No, generally what people feel that if they are investing from NR account, it is a local money actually, resident money. So it is treated as a resident investment. No, if it's no specific reporting, but they will not be able to take out their investment when they exit. It will be credited to their NRO. Yes, yes. Then there is no report. But if you are investing from NRE or from outside India, yes. Those, yes. No, sir, there is no specific declaration or anything for that. Generally, they report INVI form. The form INVI they report. So in that form, they can include those NRO investments also. Because for AIF, there is no classification available for repatriable, non-repatriable. NRO money, you can exempt it because it is treated as a domestic investment. No need to file it. Yes, sir. So we are not affiliated. In fact, we don't have branches. Many of the Indian banks don't have branches except for SBI and BOB. I guess they have foreign branches. Even if those banks which have foreign branches outside India, by their local law, they are not allowed to, source business for India. That is the restriction they have. Because I worked with a bank which had a Singapore subsidiary, but they were not allowed to source any business. We can just act as a collecting agent in that country. Collecting documents for FPI investors and all that. Otherwise, we are not affiliated. They are separate. We are separate.
Generally, importer is sending foreign currency outside India for purchase of certain goods.
Yeah.
So at the end of the year, or maybe let's say like 2-3 years, as an auditor, who might statutory audit, at that point of time, all the bill of entry has been properly filed or given to the banks, and how can I counter pending BOE? See, I can take the confirmation from the AD. How can I find it online somewhere? What is the website?
Nice. You can. I think he will address if he's champ in that for trade.
So basically, there is an IDPMS portal which is linked to these various regulatory bodies. So you will have to rely on the bank which is handling the transaction for the customer. Because a lot of times, what happens is it is possible that you send the funds overseas for a specific purchase of goods, and once the goods are there, the customer is actually using the AD code of some other bank. So the entire leg has to be completed in one bank, and if it's not, then you will have to go to each banks to get the certification properly that whether the bill of entry leg has been closed and the overseas remittance reference number is also closed. So you will have to take the support of that, because lot of times what happens is there are breaches at one bank's end, but maybe at the other bank's end they have already closed the reference number in system. So you will have to take the AD bank support for ensuring that the compliances are met.
Independently, they cannot check.
No.
All the done by from one this thing only, no? From one bank.
No, sir, no, madam. For trade, it is not that. For OI, it is there. For overseas investment, you will have to do all the investment. Any party in India who is doing investment outside India, suppose there are 10 different individuals doing investment in one entity. All of them have to come to one bank only. But for trade, that is not the requirement. Even for FDI, that is not the requirement.
For example, in one particular instance, inside India, but the concerned goods which are there, they have come to India via normal route, but the bill of entry is not available. How to close that?
So by this time, already customer must have been reported as a caution listed customer to Reserve Bank of India. Without bill of entry, it's not possible to close IDPMS. Absolutely not.
So how did the goods come to India?
Yeah.
As in,
No, means
No,
he has
I'm-
taken it with him personally, because if it's a shipping, Directly, yeah.
No, no.
Below
Right,
20 was not filed. Now.
He will be. But how
We'll have to approach to the regulator with the case. We'll have to represent it explicitly.
how it came in IDPMS first?
No. So it didn't come in IDPMS. The funds were sent, so the reference number, ORN number was created.
Yeah.
So it has to be knocked
It
off.
will go to Trade Department of Reserve Bank of India, Central Office, Amar Building.
Yes, made the 11%.
You can produce all those things to Reserve Bank of India. They will guide the AD Bank to knock that off. No, sir, there is no reporting. These are normally.
The time of remittance of.
Yes, A2 payment. It goes as a A2 payment, current account. Yes. Provided you have all the evidence of filing theirs in US and the award and all everything.
So many banks are not taking money from Western India. So is it started now or like how to do like this?
Russia, the problem with the Russia is that most of the banks in India, except for I think couple of public sector banks, they all use US nostros. Everything is linked to US nostro. JP Chase, Citibank, HSBC. Most of the banks are there. I think UCO Bank or some other bank has a direct line with Russia where oil payments are done in INR on a government to government level. For normal individuals and entities, it is not allowed. So even if I try to send money or somebody tries to send money from Russia, it will be impounded straight up.
What is the solution? Like one of the customers.
There is one option, SNR account, special non-resident rupee account, which they will have to open in India with some of the banks. Most banks have not yet come out with that operational guidelines for opening SNR. Wherever they have, you can try to see whether the Russian entity can open an SNR in India after doing all the compliances. And from there, they can settle their import-export payments. That is allowed. But normal US banking channels, it will be impounded. Although there is no restriction from government of India, but US has, so it will be impounded. Yeah, European banks also don't accept it. That is a geopolitical issue we have.
Typically, most of the Indian banks honor the US and European Union sanctions because they have nostros with
them.
these set of banks. So,
Yes.
Super banks, VTB Bank, they have their offices in India and that is based on Gurgaon. So they have.
If they are able to, if they have that kind of license from Reserve Bank of India to take payments or honor payments, you can try. Because most of them have restricted license from RBI. They can only do some restricted activities in India. So you have to check with them. Yeah, if they have opened some lines, definitely it is possible. Yeah, anybody else, anything on this thing? Can conclude if, or we can connect anytime. People are there on the ground. I think you have, guys have the numbers. You can contact anytime, sir, any discussion you want. On a no-name basis, yes, we are okay with that. Because this is the ethos of the team within the bank, IDFC First Structured Solution. We basically enter at the pre-transaction stage, post-transaction, of course, till the execution, till the reporting to the Bank of India, at every stage. So this team is specifically catering to that kind of a market. Thank you all. Thank you.
Thanks a lot everyone for being so participative. So this is just one specific topic, specific subject that we thought we should cover, because as a bank, we are aggressively working on these kind of structuring. So we are also happy to conduct any specific knowledge sessions or any specific topics if you want, even in some closed room offices or in your own premises. If you want to conduct such knowledge sessions for your team, we are open to conduct that also. We can you can reach out to us and we'll be happy to help. We are working in this space. Because typically we have identified a lot of times what happens is the end customer whom you are catering to and whom we are catering to is not aware about a lot of guidelines, and these are extremely compliance heavy transactions. So there we are trying to create these synergy with the channel partners, and we are trying to reach it out to you so that there's a seamless experience for the end customers. So with that note, we would just like to thank all of you for being so participative and helping us with a lot of queries which we can address, and we can also further better our topics so that we can cater more to you in specific detailing of the compliances. Thank you. Yeah.
I would like to thank the speaker for the very educated and informative session today. Thank you. Before we propose a formal vote of thanks, I would just make a small announcement. The ICI is hosting a startups fair at Geo World Center on 27th and 28th of June. It is a 2-day event wherein the startups will be participating. There will be startups, there will be investors, and also there will be a lot of other people who will be attending it. It is a one-of-its-kind event, and the registrations are still open. If anyone is interested, they can visit the website and register. Also, a visitor registration is free of cost, wherein you can get an access to the exhibition area. And if you want to take the delegate registration, there's a group discount that is going on a group of 10 people. So if anyone is interested, they can let me know. We can form a group and register. For now, for proposing the formal vote of thanks, I would like to invite C.A. Vijita Deswaji, who is the deputy convener. Thank you, Convener Purvi, for this opportunity. So, as the former US Deputy General Attorney General, Paul McCully has said, if you think compliance is expensive, try non-compliance. So in today's regulatory environment, it's virtually impossible to violate the rules. Thank you so much, Mr. Satish Charipalli, for taking us through the various aspects of ODI and FDI regulations, the recent changes and the impact, applicability, and the opportunities in this field we can take as professionals. Now, he gave valuable insights and practical aspects which he has gathered in his banking career. Friends, learning is a constant process, and I'm sure this cool and rainy morning, our members have learned quite a few things and become aware of FDI regulations, capital account transactions from the regulator perspective, mechanisms, amendments from time to time, reporting requirements, guidelines and implications of non-compliance, etc., where we can exercise our knowledge and create value for our clients. Special thanks to IDFC First Bank and its team for giving all our members a beautiful and practical gift of a diary. Thanks to all the members who have attended the sessions in large numbers and participated actively to make the session interactive and interesting. And of course, the staff of management of Kohinoor for good arrangements. So as a token of appreciation for our learned faculty, Mr. Satish Charipalli, I request you to please carry a loud round of applause. So we will take a short break of 15 minutes and reassemble here for our second session. Our next speaker here is already here, so I request you to be please quick. Thank you.